Your Excellencies, ladies and gentlemen, good morning and welcome to Asia House. I'm Michael Lawrence. This morning's event, Blockchain, Separating Hype from Reality, which we are producing in partnership with DWF. Distributed ledger technology was initially associated, at least in the public eye, mainly with cryptocurrencies. They have, of course, been headline news for months now, with wild fluctuations in prices, deep concerns among regulators, claims that they are vehicles for speculators, money launderers and terrorist financing. At the same time, some central banks, including the Bank of England, have raised the prospect of launching their own digital currencies. Just today, the Philippines Central Bank approved 2 new cryptocurrency exchanges, bringing the total of regulated exchanges in the Philippines to 5. But blockchain is much more than cryptocurrencies. The technology is poised to disrupt a range of industries, including banking, insurance, logistics, energy and transportation, just to name a few. According to the World Economic Forum, 10% of global GDP will be stored using blockchain by 2027. The estimate suggests supply-side improvements, such as cost and time savings, could increase global GDP by almost 5% and trade volumes by 15%. And blockchain has moved from concept to reality. In May, HSBC completed the world's first commercially viable trade finance transaction using blockchain. At the time, HSBC said the blockchain trade, which processed a letter of credit from US food and agricultural group Cargill, had shown the platform was ready to be commercially adopted across the industry. This was a highly significant transaction. Some read it as opening the door for mass adoption of the blockchain technology. Maersk, with whom we've done a bit of work, started to adopt blockchain technology formally earlier this year. It had been working with IBM to pilot schemes to track goods right across the supply chain, eliminating cumbersome paperwork, and that paperwork has barely changed in decades, in some cases centuries. So Maersk is actively now using blockchain. Blockchain can reduce processing time from several days to just hours. That's just one of the many advantages of it. At the moment, blockchain accounts for a tiny fraction of a percentage of world trade. So today we'll be exploring a number of issues, including the potential of blockchain to change world trade and the extent to which it can do so, when and where disruption is most likely to happen, and importantly, regulation. A little later, I'll be joined on stage by 3 experts in blockchain to drill down into some of these issues. But first, our keynote speaker. As I said, regulation and the role of regulators and the role they'll play in the adoption of blockchain is of vital importance. To outline some of the risks and how regulators will respond, please welcome to the stage Mary Starks, Director of Competition and Economics and Chief Economist at the Financial Conduct Authority. Mary.
Thank you very much indeed for inviting me here today. So earlier this year, I went on a business trip to Shanghai and Beijing to talk about fintech primarily, in addition to incredible food and amazing insights into the way that Alipay, WeChat and others are transforming the Chinese financial services. I was really taken by the interest shown by Chinese academics, regulators and entrepreneurs in what we're doing with fintech here in the UK. And pretty much every second question I got was, is the UK a friendly regulatory environment for cryptocurrencies and blockchain? You can understand why. Firms want to know whether their new propositions will be welcomed and supported by the authorities, while governments and regulators are trying to understand the opportunities and risks that new technologies present. The Financial Conduct Authority, the FCA, is one of very few financial regulators around the world to have an objective to promote competition in the interests of consumers. It's a top-line objective, it's in the statute. Competition and innovation obviously go hand in hand. So back in 2014, the FCA launched Project Innovate, which was a program to support innovation in financial services, including new entry by innovative businesses. It's important that that financial regulation doesn't chill or stifle innovation that is good, innovation that's in consumers' interests, that's productivity enhancing. And it's also important that we as regulators remain abreast of these developments, both in the UK and internationally, and that we're alive to the opportunities and the risks. As you can imagine, in a fast-moving sector, this is difficult, but it is also always interesting. So today I'd like to give you a bit of a sense about how we at the UK Financial Services Regulator see the opportunities and challenges of blockchain. Clearly there are applications of blockchain right across the economy, from food supply to artists' royalties to ID verification. I'm going to stick to my knitting and talk about financial services. I should also just emphasise that I am the FCA's Director of Competition and its Chief Economist. I am not its Chief Technology Officer. So I'm going to talk about, my remarks will sort of tilt towards the economic and competition applications, and I'll leave the more technical aspects to the panel that comes afterwards. So I think I better start with crypto assets. You can't talk about blockchain and not talk about Bitcoin. I suspect that it will turn out that Bitcoin is neither the most significant nor the most enduring application of blockchain technology, but it was certainly the first to hit the public consciousness in a big way. Over the past 18 months, we've seen dramatic rises and subsequent falls in the prices of many crypto assets. Over 2017, the value of Bitcoin grew by more than 16,000%, peaking in December. And from that peak, it's now come off by 62%. Nonetheless, a Bitcoin, which I could have bought for $1 in 2011, is currently worth around $6,600. So the original concept or proposition for Bitcoin and others was as a currency, as a means to pay. And while you can buy a pint of beer in London using Bitcoin, it did find more notorious uses as a means to pay anonymously on the dark web. However, as shown by the fluctuations in value over the last year or so, it's fair to say that Bitcoin and others have probably morphed from being cryptocurrencies into being crypto assets used primarily for investment or speculation. Now, financial regulators are not generally in the business of preventing speculation or trying to call when particular assets are overvalued, particularly assets which don't pose a systemic risk. However, given the FCA's consumer protection objective, we do want to understand who's investing and how much, and we want to guard against people losing more than they can afford to. So we've issued investor warnings in relation to initial coin offerings and crypto asset related contracts for difference, for example. Also, the UK government has announced the creation of a cryptocurrency task force, which the FCA is part of, to monitor developments, including internationally, and assess whether further regulatory action is required. So at the moment, the FCA does not regulate cryptocurrencies as a product, but there's an open question about whether we should do more in the future. And that task force is due to publish a report on this later this year. Having said that, financial regulators are not primarily concerned with calling when a speculative bubble has arisen. Obviously, many other people are. And if you are interested in the question of whether the Bitcoin bubble has burst, there's some very interesting work by analysts at Barclays who used techniques drawn from the study of infectious diseases to model the spread of Bitcoin fever. It's a cool piece of work. They have concluded that it probably has passed its peak. So enough about Bitcoin. Let me move on to some of the other blockchain-based developments that we're seeing in financial services. Before I do that, let me define what I mean by blockchain and distributed ledger technology, or DLT. In a recent discussion paper on this, we defined DLT as, it's rather a long definition, so wait for it, a set of technological solutions that enable a single, sequenced, standardized, and cryptographically secured record of activity, deep breath, to be safely distributed to and acted on by different participants. Now, there is a lot of words, but it gives you some sense of the range of potential applications that DLT has involving records of any sort, including records of contracts, records of transactions, records of asset holdings, and proof of identity. Those are just some of the uses you could imagine in financial services, let alone in the economy more broadly. And already we are starting to see some exciting applications of blockchain and DLT to help solve problems and iron out inefficiencies in the financial system. As a regulator, we have a particular window into this world through what's called our regulatory sandbox. So as I mentioned earlier, the FCA has this objective to promote competition and a strong interest in innovation. And we set up the project Innovate to help encourage innovation in the interests of consumers. And as part of that program, we set up the sandbox to be a kind of safe space where innovative businesses can come and test innovative products or new business models or new delivery mechanisms. They get to test these in the real market with real consumers, but within a controlled testing environment agreed with us. So it's a little bit like a drug trial, if you like, where pharmaceutical firms get to try new things at small scale with plenty of supervision. So to date, nearly 100 firms have participated in the sandbox, and in our most recent cohort of 29 firms, just under half of those will be using DLT, including 6 firms who are using DLT to issue debt or equity securities. So if we look across the sample of firms that have come through the sandbox, we can draw out 3 broad themes that those firms are seeking to address. They're looking to improve operational resilience. They are looking to use distributed digital transaction records to improve transparency. And they're looking to generate cost and time savings from removing the need for intermediaries. Many of the applications also use smart contracts, which automate payments or the transfer of assets as negotiated conditions are met. So, for example, a payment could be sent to a supplier as soon as a shipment is delivered. And I think it's still early days, but I think it's fair to say these firms are identifying workable commercial opportunities. From the first cohort of firms in the sandbox, 90% are now operating commercially in the wider market. So just how revolutionary is all this? I would say in many cases the applications that we are seeing so far involve doing something familiar but more efficiently and possibly far, far more efficiently. So to draw a parallel with the Industrial Revolution, we're talking about making textiles in cotton mills rather than on hand looms. Taking an example from our sandbox, we had a firm who used crypto assets to settle short-term debt instruments, removing the need for registrars and nominees. So while there is nothing new about short-term debt instruments, they've been around for centuries, the new technology has made the settlement process much more efficient. But if you've been reading some of the more sensationalist headlines over the past 18 months or so, you'd be forgiven for thinking that efficiency gains on existing processes was just the tip of the iceberg. Headlines have included, how will blockchain revolutionize the property market? Technology that will transform our world. These 5 technologies have the potential to change global trade forever. So clearly, blockchain has the potential to support and drive more radical innovations. So, for example, we have had talk of new offerings such as decentralized peer-to-peer exchanges, which could fundamentally challenge the way that financial markets currently function. And some commentators have argued that blockchain is a foundational or general purpose technology, a technology with many, many different uses, which could fundamentally alter a range of existing economic structures. Returning to the Industrial Revolution, we're now talking about the steam engine. But history suggests that general purpose technologies do not reach their full potential overnight. So although James Watt famously developed the rotary steam engine in 1781, it was not really until high-pressure engines arrived almost 70 years later, around 1850, that they became cost-effective for driving heavy machinery, including trains and ships. Only after that did they change the world. You can make the same point about the introduction of TCP/IP, Transmission Control Protocol, Internet Protocol, which laid the groundwork for the internet. TCP/IP was introduced in 1972, but it wasn't until the mid-90s that it gained broad use, paving the way for the dot-com boom. A Harvard Business Review article last year suggested that there are two important dimensions that determine how far and how fast blockchain technology will change the world. Those dimensions are novelty and complexity. So the authors predict that early users of blockchain will be low in novelty, they'll be doing something familiar but more efficiently, and they will require little coordination. So I can do it and it makes sense for me, I don't need you to do it at the same time to generate value. Whereas uses that are more radical, that involve doing things that we haven't thought of yet, and that require multiple parties to do it at once in order to generate value, will be longer in coming. I think it's also fair to say that we are starting to see some of the challenges with blockchain emerging. There have been experiences of technical limitations around transaction speed, privacy, scalability, as well as security and operational risks, including interoperability with legacy systems, legal and governance issues. One specific challenge associated with DLT is really the flip side of one of its strengths, which is its immutability. So there are, you can imagine thousands of uses for unchangeable and verifiable records, the truth writ in stone. But how do we ensure that the correct record is input in the first place? How do you ensure that it is the truth that is written in the stone? So blockchain offers the solution for storing the record, but it doesn't offer the solution for ensuring the accuracy of the record when it's first stored. So like any database, blockchain depends on receiving quality, accurate data. But unlike any other database, if you get the wrong data in, it's a lot harder to change it. Similarly, if we think about smart contracts, you can imagine the consequences if smart contracts were triggered by faulty inputs. So there's a lot to get right around the input side. Another related challenge is around the governance of decentralized systems. So I was at a conference earlier this year with Odysseus Sklavounis from Oxford University, who researches blockchain governance. Now, if you think of blockchain protocols as basically being the rules of the blockchain, these were until recently regarded as largely technical. It's about making the kit work. But Odysseus's area of interest is that it matters not only what those rules are, what the design of the system is, but also who gets to make those rules, and if necessary, who gets to change them, particularly when the numerous parties involved in a decentralized project don't agree with one another. So, for example, the Ethereum community experienced a split after the system was hacked. Part of the community opted to roll back the blockchain to neutralize the hack, while another part of the community opted to continue running and maintaining the version in which the hack had happened. Both of those solutions to the hack damaged confidence in the technology in different ways, but the split also highlights the fact that systems which need to evolve require governance as well as technical engineering. So, to sum up, I suppose you could draw parallels between the price movements we've seen in some crypto assets over the past 18 months and public sentiment towards broader applications of the blockchain technologies. I think we've probably progressed from a time when it was viewed with a sort of breathless, limitless optimism to a slightly more measured place. We are definitely already seeing some firms taking advantages of the opportunities created by disrupting existing processes, but there are still challenges that will need to be overcome if we're to see this technology reach its full potential and deliver the more radical innovations. So certainly at the FCA, we'll be continuing to watch with interest. Thank you very much.